Welcome back to Chapter 7. Just to review the three methods that we covered for accounting for depreciation: straight line method, double declining balance, or some other declining balance method, as well as units of production. If you recall, if we compare the declining balance method versus the straight line method, you will have more depreciation expense in the early years if you use the declining balance method. If you have more depreciation expense in the early years, it also means the book value will decline faster in the early years. It will get lower in the early years than if you had used the straight line method. Now, what effect does this have on the company's income statement? Well, depreciation is an expense. And when you use the declining balance method, you have more expense in the early years of an asset's life, which means you have higher expenses using the declining balance method, and you would have lower income for that company. If you lower the taxable income on the income statement, then you would be lowering that company's income taxes. So, if a company's goal is to reduce their tax burden in the early years and they've just bought a whole bunch of depreciable assets, then they might use the declining balance method so that they can increase the depreciation expense in the early years. Now, your book also does mention that only for IRS purposes, remember, not for GAAP financial reporting purposes, a company can use an IRS method called makers, and it just allows for a slightly faster, something like the declining balance method. It allows for a slightly faster depreciation of an asset in its early years. You will want to pay attention to the pages in your chapter that discuss the differences between the depreciation methods so that you can understand the effects that they have on the income statement and the balance sheet. And that information is found on pages 343 and 344 in your textbook. Now, what happens if a company, after it's already purchased the asset and used it for a while, it does some maintenance on that asset, or it has other expenditures on that asset after it had already acquired it? Now, they could be ordinary repairs, or they could be major overhauls, major improvements. What if they do a factory overhaul, or they add on to the factory? How do they account for that? Well, we need to first determine whether they are revenue expenditures, which are expenditures that are more like maintenance and just mere repairs, minor things that do not cause the asset to have more future benefit. It's just repair it to keep it useful for right now, but it does not add future economic benefit. We call this a revenue expenditure. We will just expense that particular expenditure in the same time period. However, if we do something called capital expenditures, it means that we have done something to the asset that extends its life or in some way improves the future economic benefits. If so, we also, when we deal with that particular expenditure, we need to cause the value of the asset in our asset account to increase. We'll actually make a debit to our asset account. Now, this chart in your book helps you understand some of the types of things you can do to an asset to determine whether it's a revenue expenditure or a capital expenditure. If it's a capital expenditure, again, we increase the value of the asset, which means now we're going to need to capitalize that new increase, so we'll have to depreciate it. This chart can be found on page 346. Now, what do we do if we have a capital expenditure after depreciation, or some other thing that happens? Well, we could perhaps have a revision because the useful life has been extended, or perhaps the residual value will be different, or we've made those capital expenditures. What do? First, we need to obtain the current book value of that asset at the date you are revising the asset value, which means you've got to find out exactly how much that asset is worth on the books. That means the original cost minus all the accumulated depreciation as of that date. Then you need to compute the depreciation expense using revised information, whether that's new book value, new useful life, new residual value, or a combination of all three. And then you will use that new depreciation expense going forward. Notice this only affects the current and future years. You do not go back into your journal entries from previous years prior to the revision. You don't go back and make any changes. You only make changes from here into the future. So let's look at an example to see how this works. Read the information for the Parker Publishing Company and their printing press. Okay, what was the value, the book value of the printing press as of January 1st, 2011? Well, they bought it for $300,000 on the first day of 2003. They expected it to have a residual value of $50,000. And as of December 31st, 2010, the book value was $100,000. But on the date, January 1st, 2011, they paid for $90,000 worth of additions to that printing press. So, what's the book value of the printing press on January 1st? Well, milliseconds earlier, on December 31st, 2010, the thing was worth $100,000. But on January 1st, 2011, they did $90,000 of capital expenditures, meaning expenditures that will cause this printing press to increase its future economic benefit. So we must add the value of those capital expenditures to the book value that it was just moments before those expenditures. So $100,000 plus the $90,000 of expenditures gets us $190,000 of a revised book value as of January 1st, 2011. Now, what amount should Parker Publishing Company record for depreciation expense for 2011? Remember, they did those capital expenditures conveniently on January 1st, 2011. So it has, as of January 1, 2011, it has a new book value of $190,000. Notice, the useful life is now 6 years. From January 1st going forward, the useful life will be 6 years, and the residual value will be $10,000, not $50,000. Well, if they use the straight line method, which we learned in the problem they do, we would say that depreciation expense is always the book value minus the residual value divided by the useful life. What's the book value right now as of January 1st? It's $190,000. What's the new residual value? $10,000. What's the useful life now? 6 years. So we take all that information and we plug it in and we come up with the fact that the depreciation expense for 2011 is $30,000 per year. So we have a revised book value of $190,000 and a revised depreciation expense of $30,000, which we got in this part of the problem. So let's do a journal entry. How would you have recorded the change in the asset value on January 1st, 2011? Well, you would have made your entry for January 1st, and we aren't purchasing new equipment, but we upgraded the equipment to the tune of $90,000, so that would have been a debit. We increased the value of the equipment asset, and then we presume the company paid cash for it. They didn't say that they went into debt for it, so we would have credited cash $90,000. What journal entry would you need to do to record the depreciation expense for 2011? Well, we said that at the end of 2011, the company would have made a depreciation expense entry, which is a debit entry, for $30,000. And what do we do when we're making our depreciation adjustment every year? Right. We make a credit entry to accumulated depreciation, that contra asset account, for $30,000. Now, sometimes the change in the asset is not to increase its value, but it is because the value is no longer as valuable. And we call this impairment. Impairment often happens because an asset is no longer worth what we thought it was. This is very common in technology-based assets where they become obsolete faster than the company expected. It is a permanent decline in the future benefit or the service potential of the asset, and it is called an impairment. Now, it's possible that the original depreciation method was just inappropriate. Maybe the useful years were too long, or the residual value was too high, or something like that, but it's also because the asset has become unexpectedly obsolete. Again, very common in technology. This does require a journal entry. The journal entry would cause us to debit an account called loss from impairment. This is an income statement account. It is an expense account. That's why we debit it. And it is called loss from impairment. We would then credit whatever that fixed asset account was. So if it was a piece of equipment, we would debit equipment. Now, another way to change the value of an asset is to dispose of it. So we would just take it off our books altogether. Now, this could be voluntary, meaning the company just wants to sell it. It's not as useful to the company anymore. It could be the end of the useful life or some other time. But there could be involuntary disposal. And what does that mean? Well, could be some sort of loss or destruction of the asset, whether through theft or some sort of act in nature or an accident. Now, we need, especially involuntary disposals, but also voluntary disposals, we need to remember that these are rarely timed for the exact last day of an accounting period. You can't time a hurricane. You don't always get to time when you can sell something. So, to record the disposal of a fixed asset, we'll need to make an entry to record the depreciation expense that has accrued up to the date of the disposal. The other word we sometimes use for this is disposition. So let's say that perhaps an asset has been destroyed in a snowstorm that occurred on October 31st. The end of the company's normal accounting period is December 31st. But obviously, even though we haven't reached December 31st yet, there has been 10 months of accrued depreciation that would have occurred at the time that the asset was destroyed on October 31st. So we need to figure out how much depreciation expense occurred up to the date of disposal. We would also then need to make an entry to remove the asset's book value. We need to basically take the asset off our books. So that means we need to credit the fixed asset account, whatever it is, equipment or land or building, and we need to debit accumulated depreciation, and thereby we clear out those accounts for the value of this asset. We also need to record any gain or loss on disposal of the asset, which could happen, especially if the asset were sold. We could actually make a little money. We do this by finding the difference between the proceeds from the sale, the amount we actually received in the sale, and the book value of the asset. So we would debit cash, and we would credit any gain or loss on disposal of the asset. So let's just look at an example. We've got the Dickerson Corporation, and they've got a machine that they've decided to sell on July 1st, 2011. Read the information. So, for the machine that Dickerson Corporation sold on July 1st, we first need to figure out how much depreciation expense had accrued during 2011 for that machine. Because normally we would have accounted for depreciation expense at the end of Dickerson's year, which would have been December 31st. However, they're selling this machine on July 1st. So how much depreciation expense would have accrued? Well, the information in the problem tells us that depreciation expense for the first 6 months of 2011, which would be right up to the day before July 1st, was $5,000. So we need to record that. At July 1st, we would have made an entry of a debit to depreciation expense of $5,000 and a credit to accumulated depreciation, because that's always how we do a depreciation entry, of the exact same amount. This records depreciation through the end of June 2011. Then we need to figure out what is the gain or loss on the sale of this machine. Well, what was the amount the company received for it when they sold it? They sold it for $22,000. So they received $22,000. What was the book value that was on the books as of July 1st, 2011? Well, we know that the machine originally cost $100,000. We also know that accumulated depreciation as of the beginning of 2011 was $80,000. Did we add any accumulated depreciation in 2011? Well, we did, right? Because we recorded the first 5 months of depreciation. No, excuse me, I'm sorry, the first 6 months, which was $5,000 for 2011. So the gain or loss is always going to be whatever price we receive when we sell it minus the current book value. In this case, the current book value would have been the original cost of the item minus all the accumulated depreciation we knew as of January 1st, and then we also have to subtract the additional accumulated depreciation that we entered in that previous journal entry as of July 1st. So they received $22,000 in cash minus the current book value as of July 1st, 2011. If we take $100,000 original value minus $80,000 of accumulated depreciation at January 1st minus the additional $5,000 in accumulated depreciation, we find out the machine had a book value of $15,000. That means the company sold it for more than the book value. Would you consider that a gain or a loss? Well, that would be a gain. They got more cash for that machine than they believed it was technically worth according to the book value. It's a $7,000 gain. Now we're able to actually prepare the journal entry to record the disposal of the machine, the sale of the machine. First off, they sold the machine and they received cash, right, on July 1st. So we need to take care of that cash debit. They got $22,000 in cash. What else do they need to take care of? Well, we said we need to get this machine off the books. It's no longer going to be owned by Dickerson Corporation, which means we need to take care of getting rid of it off the asset value. Now, in order to get the machine off the books, we would have to credit the equipment account, right? That clears the value of the machine out of the equipment account. But we also need to debit all of that accumulated depreciation. So we would need to make a debit entry to accumulated depreciation for the total accumulated depreciation associated with this machine. Remember, that's going to be the $80,000 that we had accumulated up to January 1st, plus the $5,000 we added as of July 1st. So we now have an $85,000 debit entry to accumulated depreciation. Now, the other piece of removing this asset from the books is to take care of clearing the equipment account of this asset value. So we need to credit the equipment account for the total book value, the original total book value, which is the $100,000. Lastly, we need to take care of the gain, the $7,000 gain on disposal of equipment. Now, the gain or loss of value based on disposal of equipment, that's considered an income account in this case because there was a gain. And how do we record an income or a revenue? Right, it's a credit. So it would be a credit entry of $7,000. If we add our debits, $22,000 plus $85,000 is going to be $107,000, and we add our credits, we find that they're both equal to $107,000. Now, what if Dickerson Corporation sold the machine not for $22,000 in cash, but $12,000 in cash? What would be the gain or loss on the disposal of that machine? Well, we would have received $12,000 minus, we actually, if you recall, the total book value of that machine would have been $15,000 as of July 1st. Notice the only thing that changed in the problem information was what they sold it for. They still would have had the same book value and the same depreciation expense booked on July 1st. So if the machine had a book value of $15,000 on July 1st and they sold it for $12,000, would that have been a gain or a loss? Right, it would have been a loss because they sold it for less than the book value. It would have been a $3,000 loss. So what would that entry have looked like if they sold the machine for a $3,000 loss? Well, we still get to book whatever cash they receive as a debit. They didn't receive as much, but they still did get cash, and every time a company receives cash, that's a debit to cash of $12,000. We also still need to clear all of the accumulated depreciation, and the only way to do that is a debit of the total depreciation, which was $85,000. Notice that did not change. Now in this case, we had a $3,000 loss. That has a negative impact on income. In order to reduce income, we have to book a debit. Remember, income accounts have a normal credit balance, so a loss on the sale of an asset is actually a debit entry, a debit of $3,000. Then we would have, in order to clear the equipment asset account, we would have a credit of the full original book value, which was $100,000. Notice $100,000 of credits, we now have $100,000 of debits. When there is a loss on the sale, it is recorded as a debit. Gains are recorded as a credit. One last thing to notice here. Remember, we kept clearing the equipment account, the asset account, by crediting it for its original book value. If the company had made capital expenditures on this machine at some point before July 1st, 2011, then the total book value would also have needed to include the value of those improvements, those capital expenditures. We did not have that in this problem, so the total book value that we credited the equipment account for was the original cost, the original book value of the machine. Now, in the remaining portion of your chapter, we do discuss natural resources as well as intangible assets. You are responsible for understanding how natural resources work, how we deplete the value of natural resources, and we amortize the value of intangible assets, very similar to the concept of depreciation, but we use different words. However, we will not be going over cornerstones 7-8 and 7-9. You will not be responsible for those, though you do need to understand in general how natural resources are depleted and how intangible assets are amortized. This concludes Chapter 7.